This is a book bull summary of the book Simple Numbers, Straight Talk, Big Profits by Greg Crabtree and Beverly Blair Harzog. You're running a small business and things are looking up after navigating through some initial challenges. As you contemplate the next steps, it's common to think about increasing revenue and boosting sales. The instinct might be to borrow money, hire more staff, and take every order to keep the cash flowing. However, that might not be the best approach. Contrary to popular belief, these insights will guide you away from a common but misguided strategy that could lead to trouble. Instead of fixating on incoming revenue, it's crucial to pay attention to the money going out. Revenue isn't everything if your expenses surpass your earnings. The real key is profit, and these insights will steer you towards securing it. Business owners must ensure they pay themselves a fair market wage. Here's a surprising fact. 90% of small business owners pay themselves less than a fair market wage. While it might seem like a sensible decision to cut personal wage costs and boost pre-tax profits, there are compelling reasons to ensure you're paying yourself appropriately. Firstly, not paying yourself or your employees a market-based wage can harm your business. Metrics like pre-tax profits and labor expenses significantly impact vital financial measures, such as labor productivity and the percentage of pre-tax profits to revenue. Later, we'll delve into how these metrics influence the success of your business, and tampering with them could hinder your company's growth. It's essential to note that the U.S. Internal Revenue Service has flagged the practice of underpaying wages as a dirty dozen tax scam among closely held S corporations. Consequently, the federal tax agency is increasingly auditing firms suspected of adopting this approach. Secondly, paying yourself a market-based wage becomes crucial when considering selling your business or making an exit. A firm's profitability is a key factor in determining its fair market value. When an external party examines your books before acquiring your company, artificially lowered wages might raise doubts about your company's value in the eyes of a potential buyer. On the flip side, consistently paying yourself a market-based wage will prevent cash flow issues and the unpleasant surprise of reduced profits if you decide to exit and bring in an outside CEO expecting market wages. Prioritize solid profits to navigate your business through its crucial adolescent phase. Every business faces a critical juncture when growth brings challenges. This isn't about space exploration. It's when a company's revenue surpasses $1 million. There's a rising demand for staff, but insufficient capital to pay for new hires. During this phase, many leaders focus on budget balancing, but that's not sufficient. To escape this challenging situation, the target should be a 10 to 15% pre-tax profitability. Imagine it like a pioneer journeying from Kansas to California in a wagon. Even with initial provisions, depleting resources too quickly without replenishing them, or incurring losses without building profits, can derail your progress. Therefore, the goal is to accumulate healthy profits while growing. Reinvesting profits and building capital reserves becomes the key to navigating this challenging phase successfully. Moreover, the benefits of profitability during this period extend beyond. If you decide to sell your business, historical profitability significantly influences its value. Potential buyers will scrutinize the last 3 years of pre-tax profits and business equity, a common measure for assessing value. A company achieving 10 to 15% pre-tax profitability will command a much higher market value than one with smaller profits or none at all. If optimizing your company's market value is your aim, the next insights will guide you in achieving that goal. Control labor expenses and safeguard 10% of your earnings by introducing a salary cap. As we covered earlier, aiming for a 10 to 15% profitability is crucial for your company. But how do you maintain this during the challenging phase when you need to hire new staff to meet increasing demand? Firstly, it's important to grasp the connection between labor expenses and profitability. Labor is a significant business cost, but unlike fixed expenses like rent, you have control over labor costs. Introducing a salary cap is a key step to safeguard at least 10% of your profits. Let's break it down with an example. If your revenue is $1 million, target profits of at least $100,000. Deduct all non-labor costs from your $900,000 operating budget. The remaining amount becomes your firm's total salary cap, encompassing all labor costs, including your own market-based wage. To keep growing, use the salary cap as a guide, fluctuating between 10 to 15% profitability. If you initially set a salary cap based on 10% profits, aim to recalibrate it for 15% as you grow profits. During this period, prioritize improving productivity over expanding revenue. Once you reach 15% profitability, strategically hire new staff to boost revenue until your profits are back near 10%. Repeating this process is the safest way to grow your business while staying profitable. Concerned that a salary cap may hinder performance? Look at Bill Belichick's success as an example, the New England Patriots coach with numerous Super Bowl victories. He navigates the National Football League's strict salary cap smartly, getting more value for every dollar spent by investing in younger talent. You can do the same. Boosting productivity is essential for staying within your salary cap and reaching profitability. To boost your company's productivity, consider enhancing the effectiveness of your current workforce rather than just hiring more staff. So, how can you actually increase and sustain labor productivity? Start by measuring productivity using a simple equation. Productivity equals gross profits divided by dollars spent on labor. To calculate gross profits, subtract the cost of goods sold from revenue. Though it may seem basic, this equation is a powerful tool. It validates your instincts and enables you to quickly identify and address negative trends. Once you've calculated this metric, implement new practices to improve productivity. Ensure your employees are fairly compensated. Paying too little leads to high turnover, disrupting the workplace and hindering productivity. Overpaying can eat into profits, particularly if job requirements have diminished due to technological advancements. Strive to pay a reasonable market-based wage. After adjusting your compensation structure, introduce an evaluation system to further boost productivity. Benefits include managing employee expectations better, identifying areas for improvement, and focusing on career planning. Encouraging skill development and motivation improves employee retention, saving time and money. For effective evaluations, pinpoint 3 to 5 skills per role that can enhance productivity. Additionally, ask each employee to explain how their role contributes to the firm's targeted profitability level. Focus on the essential elements of cash flow, taxes, debts, core capital goals, and distributions. Running a healthy business involves more than just labor costs. To stay financially stable, it's crucial to grasp the 4 forces of cash flow. Here they are. 1. Tax. Set aside money for taxes to avoid liquidity issues, even if your business is profitable. 2. Debt. Failing to meet debt payments puts you at risk of default and foreclosure. 3. Core capital target, CCT. Maintain a buffer for normal cash flow fluctuations. Further details on this are discussed below. 4. Distributions. Only consider distributing profits to yourself after addressing the first 3 forces. It's vital to build sufficient cash reserves before making distributions. Reiterating, distributions should not be paid until you've established a robust reserve to handle tax, debt, and CCT. The 10 to 15% profitability goal is crucial for cash flow management. Reinvesting profits helps your business reach the core capital target. Keep these forces in mind, especially during the inevitable highs and lows of the business cycle. There will be tight money periods like tax time when funds flow out. The core capital target, CCT, acts as a safety net for these cyclical swings. Calculate the CCT by reviewing your firm's history. Typically, building up 2 months of operating expenses is recommended. In rare cases, such as startups dealing with long receivable waits, the CCT might need to exceed 2 months. Investing profits to create this buffer should be a top priority before considering distributions from the company. Choosing to use your savings instead of taking on debt is a smarter option when you need to raise capital. Maintaining a profitable business, a safer route to capital than borrowing. While it's true that maintaining a 10 to 15% profitability is the best way to raise capital, some may consider borrowing as an alternative. However, it's crucial to understand that debt is risky and should only be a last resort. Borrowing other people's money often leads to taking higher risks. In contrast, starting a business with your own funds makes you more cautious. The same principle applies to borrowed money, including startup capital from venture capitalists. These investors usually expect significant growth in returns, and when a company's growth levels off, they may decide to sell business assets. If you lack upfront investment, consider sweat equity. While it's essential to pay yourself a fair wage, temporarily accepting a below-market salary is preferable to taking on debt. This approach allows you to live on your savings rather than your firm's after-tax profits. For instance, if your market-based wage is $75,000 annually, forgoing a salary in the first year and paying yourself $25,000 in the second year adds $100,000 to your firm's equity. This dedicated work ethic not only contributes to your business's success, but also ensures a focus on productivity and profitability, the safest path to rapid wealth creation. Consistently keeping an eye on important indicators enables you to notice patterns and promptly respond. Unlock the potential for your company's success by discovering insights hidden in data. Consistently monitoring key measures is the key to thriving in business. Avoid overwhelming yourself with too many numbers. Instead, focus on a few crucial metrics essential for your company's survival and positive growth. It's vital to keep a close eye on your daily cash balance, especially for new businesses, as they are susceptible to cash deficits in their early months. Daily monitoring allows you to stay on top of bill payments. On a weekly basis, concentrate on 3 key metrics: sales, labor productivity, and the cash flow forecast for the next 2 weeks. Analyze these regularly to identify trends and address issues promptly. Create a meaningful profit and loss (P&L) statement to spot trends and make necessary adjustments. Consider using a rolling P&L, focusing on the last 12 months, to reveal long-term trends and ensure you meet your profitability goals. This approach provides insights into whether your salary cap aligns with your targets. Keep a close eye on metrics to predict your cash flow and spot issues before they arise. Mastering cash flow forecasting for effective business growth. Once you establish a routine of keeping an eye on important metrics and recognizing trends, you can take it a step further by incorporating forecasting to dynamically guide your company's growth. Cash flow forecasting may sound complex, but it's actually quite manageable. Here's a simple breakdown. Start with your profit and loss (P&L) statement, identifying future costs like rent that you can predict with confidence. Then consider costs such as labor, where you have significant control. By examining your performance over recent months, you can make informed estimates for items like operating expenses and projected revenue. Since the focus is on forecasting cash flow, your P&L history will also highlight pending payments. This information not only helps predict future cash flow, but also exposes any inconsistencies. The strength of forecasting lies in periodically reviewing and validating the accuracy of predictions. This practice offers insights into potential issues before they escalate. For effective forecasting, consider all key metrics, such as labor, productivity, and accounts receivable, in relation to your profit target. Working backward from your profit and core capital target (CCT) goals enables you to identify desirable rates for productivity, labor costs, and other factors. After setting these benchmarks, assess your progress. Have you achieved your goals? Is your trajectory positive or negative? The answer to the second question is vital, serving as an early warning if things are heading in the wrong direction. This allows you to examine your metrics, identify issues, and take corrective action. Remember, companies can't pivot instantly. Understanding the connections between various metrics provides time and the chance to steer your company in the right direction before facing significant challenges. We hope this video provided valuable insights and information for you. What is your biggest key takeaway? Let us know in the comments below. And if you learned something new, make sure to hit the subscribe button for more videos like this. Thank you, and until next time.